I think some of the smart beta stuff is quite interesting. If one believes that the vast majority of an active manager's returns actually come through effectively smart beta or entrenched style biases, which can be more cheaply replicated, then why should you pay an active manager 75 basis points for a fund when 90% of his or her returns come from factors that can be replicated for a fraction of that cost. So I think smart beta is something which I think is very interesting, because what it essentially enables investors to do is to say, well, look, I don't just want to buy the FTSE All Share because it's got all sorts of sectoral biases. There's going to be lots of stuff in there I don't necessarily want to own, etc., etc., etc. But actually, this smart beta product, you can get a smart beta product that perhaps, filters out the dross, perhaps focuses more on, yielding stocks, or whatever it might be. So I think the second generation of ETFs, which allow an investor to, I think, are potentially more interesting than just bog standard ETFs, which just give you market beta.
I think that it's wrong to call it smart beta, and it's a bugbear. The smart should be moved up to the asset allocation. That's where you prove whether you've made a difference at a much higher level. In the smart beta, as it's called, range, it should really be called factor-based investing. You decided that you want to have dividend income, so in the S&P 500 you choose the highest dividend. That's factor-based. It should be operational, mechanical. If you say smart beta, you're starting to imply that there's a manager who has to pick stocks, and then you're not really doing what ETFs are supposed to do. I think that factor-based investing with ETFs can make sense. If you're a conservative investor and wish to stick to a core portfolio of FTSE 100 or S&P 500, you may wish to strip out certain elements that worry you. You may wish to choose ETFs that have only stocks that have a lower debt to book value. You may choose stocks that have a higher dividend return if you're income hungry. So factor-based investing is here to stay again, and I think that it is very investing, but don't call it smart beta. Smart beta makes it sound like the investor puts their money in and somebody is being smart on their behalf so they can relax and go and do something else. That's just not going to happen. The factors will be applied mechanically and operationally, and the values will go up and down with the market. There's nobody looking after the money inside smart beta. And that's why I think it's mislabeled.
The further our conversation goes away from these plain vanilla products, how far into the darkness, the unknown can we go? We hear about ETFs tracking floating rate note indices. Do you feel there's a finite amount of development for these products, and some providers are perhaps straying a little too far into fantasy land?
I think you have to keep in mind for which client group you're talking about. For the institutional, professional clients, you can use a lot of different strategies and be very innovative. With regards to the floating rates, I think that's an interesting one. The danger with some of the either label it as smart beta or more active ETFs is that we've given it an ETF brand, and that's what the clients understand. And they're either buying it themselves and they think they're doing the right thing. However, regulation is going to want to know what is driving these ETFs, and maybe they will actually be deemed as too complex. So we've got to watch out that we're not trying to break something which is actually working pretty well.